Well, welcome back to the hot seat. Delighted to be joined today by Sidd Kapila, who is an investment advisor at Berenberg Bank in London. Welcome, Sidd.
Thank you, David. Pleasure to be on.
So looking forward to creating some interesting content over the next few months with Berenberg, which we're going to discuss a little bit in this session. But for PCD members who haven't met you before, Sidd, or are less familiar with Berenberg, why don't you tell us a bit about the bank and your role?
Yeah, sure. I mean, that'd be quite understandable to be a bit less familiar with Berenberg. It's quite interesting. Berenberg were actually founded in 1590, making them, I think, the second oldest private bank in Europe. So to give you some numbers, we have about 40 billion euros under management, 1,600 employees. We operate in 16 locations around 6 different countries. So there's a long heritage there of private banking expertise. However, in the UK, it's fair to say we're better known for our investment banking capabilities, predominantly research. And that's fair because the investment bank has been very successful in recent times, as well as supplying over 1,000 companies with our independent research. The second element to that is that the wealth and asset management part of the business was only established in the UK in 2011. So it's relatively new. But in that time, we've grown to about 4 billion euros in assets under management. And we have a full service offering now. So this is a time when we're looking to expand our presence in the UK and get people a bit more familiar with the brand. So yeah, that's where we are. In terms of my role, I'm an investment advisor within the wealth and asset management team in the UK. So I predominantly straddle both sides of the business, being wealth and asset management. On the wealth side, I'm the point of contact for our private clients, and I'll typically arrange their investment advice and strategy, and also coordinate the services we provide in-house and our different teams, but also the services that we draw upon from external firms to help us better serve the clients holistically. On the asset management side, I'm primarily talking to institutions about the products and services we provide, which will help them serve their clients. So that's mainly our currency overlay strategies, equity protection and hedging strategies, and our equity fund range.
Okay, thanks. And what kind of advisors do you typically work with within the PCD audience?
Well, probably most of them, to be honest, at some stage during a client's life cycle. We believe in specialists. So we believe in specialist advice as opposed to generalist advice. So we like to think of ourselves as a specialist investment manager. And when we're talking about private clients in particular, we would look after their investment management affairs. But of course, being the private client business, you form very deep relationships with clients, and you become a trusted advisor where they turn to you for all types of different concerns and queries that they might have. A lot of which of those we would then look to partner with specialist firms in those areas. So a good example is tax. We have to be aware of the tax implications of what we do. It's something that will affect all of our clients all the time, but we are not allowed to give tax advice, and therefore we look to form partnerships with firms who embody the same values as we do around client service, professionalism and capability, and then we draw upon them as and when those queries come up, which, as you can imagine, is quite common with what we do. But not just that. I mean, we would look to partner with firms who, for example, would specialize in mortgages, because we don't provide those either. But we're so deeply rooted in our clients' financial affairs that they'll come up from time to time, and they may look to us about lending requirements or look for a recommendation. Legal is another good example where that's very similar to tax, comes up pretty much day to day for our clients, and we need to have those services on hand to sort of form, you could say, a band of advisors that together, working collaboratively, can get the best outcomes for the end client. So that's what we aim to do, and the hope is that those firms would look at Berenberg and feel the same way about what we do and our capabilities, and look to entrust us with any way we can help their clients as well.
Okay, thanks. I mean, the wealth management marketplace is a very crowded trade, if you like. I mean, are clients coming to Berenberg just looking for something different. They know there's all the brand name wealth managers out there that they might have heard of before. What is it that they're looking for out of Berenberg?
It's a good question, and there are a few idiosyncrasies with Berenberg. I think that's what makes it quite special. I guess if you focus on the private client side, the wealth side of our business, because that's probably the more in focus aspect for the PCD audience. There's a few nuances to what we do. So I guess the first thing is that clients are attracted to us because we're privately owned, and that has significant advantages. The first of which is that clearly we don't have shareholders to think about, which if you've ever worked for a firm which does have shareholders to think about, you can sometimes see the detriment that it might have in terms of you have to have a short-term mindset on results to deliver for shareholders, but that doesn't work well with the long-term mindset you need to have to look after clients. So you find that clients who want continuity, the same name, same face, they get familiar with their affairs, and the same advisor and the same representative of a firm is who they're always talking to, can sometimes be put at risk at those firms due to cost cutting or restructuring, and that can be quite a big problem for a lot of private clients. So that's not something that Berenberg has to deal with, and it means that in times of economic strife like we've just had, Berenberg can continue to build resource and look through it for the long term, and that does come out in terms of client service over time. That is felt by clients. I think word of mouth in that respect brings a lot of clients to our door. The second aspect would be our investment style and capabilities. So of course our performance has been very good, and that always gets people interested. But the second aspect is a little bit more niche in the sense that we are typically regarded as better investors for capital growth. And I think a lot of UK investment houses, given they have a UK bias, tend to be more well versed in income investing. So if you think of a client who's multi-banked, for example, having 4 different investment managers who are all UK based, investing in similar portfolios gives you quite a lot of exposure to the same underlying securities, whereas investing with Berenberg gives you a bit of diversification in terms of what you're exposed to, but also can help strategically in terms of having a more income focused house and a more capital growth focused house with a little bit more European exposure, and therefore not doubling up in the UK. So that's a big pull, I would say. And I think another key criteria is the fact that, in my mind, boutique firms are able to service their clients better and be far more responsive and have better levels of client service with ease because of the shorter lines of communication and the sort of team approach to client work. The problem with boutiques is that sometimes they suffer operationally and things can take a while to get over the line despite the decision being made very quickly. But with Berenberg, for the moment and for the foreseeable, because the UK arm is relatively new and we're a small team here, we operate as a boutique in the UK with all of the capabilities of a larger bank, given the connection to our investment bank and also our private banking arm in Germany. So you don't have those operational distractions. And I think that is something that clients who are with Berenberg now feel, and clients who look to Berenberg are quite excited by. And then I guess the breadth of our offering is the last one, in the sense that you don't just get access to our multi-asset portfolio managers, you get access to our world-class institutional fund managers. And that's something that's quite rare for private clients. Usually you have to be a multi-billion pound institution to access those people, but we are able to give them access to, without exaggeration, some of the very best European institutional equity investors in the market at no extra cost. And also, because of our research capabilities and that we are embedded within the investment bank, we are not separate, means that all of our processes, for example, our advisory process, is very robust, and therefore we can offer a comprehensive advisory process with a demonstrable backing as to how decisions are made and what stocks are selected at competitive cost, which is something that the industry struggles with. The advisory service is something that clients want, but it's very difficult for larger banks without those sort of ties into an investment bank to deliver satisfactory, I would say. So I'd say that those are probably the key criteria that bring clients to our door and get people interested in what we're doing.
Thanks. And on the institutional side, I mean, the fund range has now reached its 3-year track record. It's an important milestone for investors to be able to assess it over a reasonable time period. I mean, how are you seeing the fund range as part of the toolkit for you that you advise clients on?
Yeah, I think that's a really important point. The 3-year was crucial. We obtained that in November last year for our European section of our range. So our range is European, but we also have a global fund and a sustainable world fund, which is our impact fund. And you needed to have a 3-year track record. It's interesting because it's probably the part of the service at the moment that Berenberg are most proud of. And it's probably the most exciting time to be looking at it. We were lucky enough to, as I mentioned before, bring on a world-class fund management team who had built up a reputation over 2 decades of delivering our performance. And when they came to Berenberg, there was a case of 2 aspects needed to be reached. We needed to get sufficient size within the funds for them to be taken credibly by investors, and also hit a 3-year track record of our performance to show that the style still works. There is something there where it can be compared with other similar funds, apples for apples. So because of the reputation of the fund managers themselves and their personal track record, the asset side wasn't too much of an issue, and organically clients followed them and ignored the lack of a track record to some extent to get decent size within the funds quite quickly. But we simply couldn't accelerate time. That's one thing you just have to wait for. And you need a 3-year track record, importantly, to get ratings from important firms like Morningstar and Financial Express. So having done that now, we've obtained our 5-star Morningstar ratings. We've obtained our 5 crowns ratings from Financial Express and ESG ratings from MSCI, which enables us to now talk to the market a bit more actively about what we're doing and show them the outperformance that we've achieved, which is exciting. So they're on a very strong growth phase. I mean, in 2017, when the funds were established, we had 50 million. Fast forward 3 years and the fund range is now at 4 billion. So accelerating through growth, and all the numbers are there. So the funds, no fund is outside the top decile as of now. And I believe 3 of our funds are in the top centile. So we conduct our own peer group analysis against the best funds in the world that we think are our competitors. And so far we are, I think, pretty much outperforming all of them, or very close to those that are outperforming us. So definitely a very, very viable solution for anyone looking at Europe.
Have you noticed an uptick in demand for the sustainable fund solutions? I mean, sustainability and sustainable investing is everywhere in the financial press right now, and I think in the last 12 months has been a dominant trend. Have you noticed any uptick, or it's been more part of a gradual trend to consider how clients are investing?
I think it's definitely the buzzword at the moment. You know, ESG is what everyone's talking about, and rightly so. And we have seen a lot of more interest, I'd say, in what we can do in terms of sustainability and impact. And a big part of that in private wealth is due to the sort of phenomenon we're seeing at the moment, where wealth is being transferred to the next generation, and the next generation, probably sort of my generation, is very much focused on climate change and the impact we're having, which is great, because the sort of overarching theme is that companies are now being held accountable in the way that they conduct their business, which is definitely a good thing. And it regardless of whether firms are paying it lip service and adjusting their the way they operate just to not be left behind, it doesn't really matter. The good news is that they're doing it. And I think the important piece is everybody's learning. It's moving so quickly that we're getting there day by day. So I'd say that one important factor now is, if you compare where we are right now with ESG, sustainability and impact compared to 3 years ago, we separate out ESG from impact, which is an important distinction to make, which we weren't making 3 years ago. And I would say that on the ESG side, we're getting closer to having a framework by which we can compare different firms, different investment houses, different end companies on how they operate. Berenberg's always done well on an ESG perspective, because it's embedded within the investment philosophy here that we want to invest in companies for the long term that have excellent management teams and are governed very well, because that has to be part of our investment process for it to work. So as a byproduct, almost, we were always going to score well on ESG. I think impact is where firms have a little bit more work to do, because it's a much more nuanced space. It's much harder to quantify impact. And it's great to see all the different approaches that firms are taking in order to try and accomplish that, and being brave in terms of not settling for what the current metrics we have are, and questioning whether they're good enough. So I know that Berenberg, as an example, are doing a lot of work in-house to produce our own proprietary ways of quantifying our impact and the impact that our portfolios have, rather than relying on outside sources and critiquing outside sources to make them better, using what's good about them and discarding what's not, in the hope that we will get to a point where we can articulate to clients and investors very easily where we are with impact. So watch this space, but there's a lot of work definitely going on that side, and I think everything's very positive from Berenberg, at least in that aspect. And the best bit is it's now we're starting to see data where it is not at the detriment of investment returns, and I think that's really important. We now have a sort of 2-year track record where we can show that actually investing in ESG mandates or impact mandates doesn't necessarily hurt your returns at all, and in some cases can actually benefit them. So yeah, it's great, and we'll see where it goes from here.
Okay, and obviously there's many ways in which clients can access these funds, both coming through the private bank or through financial advisors. So you work with financial advisors constructing portfolios, perhaps using third-party funds. I mean, perhaps you could explain a little bit about how that works and what the take-up has been in the marketplace in the UK for those that fund range amongst IFAs.
Yes, well, we work with IFAs in 2 ways. I would say that add value to what they're doing. I'm going to oversimplify what IFAs do here, so apologies to any IFAs in the audience. But the way I would sort of describe it is the smaller IFAs who tend to focus on the financial planning aspects of their client work and look to outsource the investment expertise. They pick a house that they think is credible, that they believe in the investment style, and sort of appraise it, and then let them run the money outside. We can serve those IFAs through our multi-asset portfolios, which are risk rated 1 to 5. And they are a good solution in terms of having all the reporting available for IFAs to talk about what they're doing with their clients. And then the second branch of IFAs, I'd say, are the slightly larger firms who prefer to run the investment piece in-house, but utilizing third-party funds and critiquing the fund managers there. And in that sense, that's part of the segment that we've been able to speak to more actively following the 3-year track record and Morningstar and FE ratings, giving them the tools they now need to compare us with our peers. And we've been showing them why our funds are maybe a superior choice compared to what they currently have in portfolios, given all the data is there now, and getting them to meet our fund managers and speak about the process, getting them familiar with what we do in Europe and how we do it. And the uptake's been very, very positive since the 3-year. One thing that came out of discussions with UK IFAs and really the wholesale market in general was that an ex-UK version of our European focus fund would be something that would help them a lot, because it would help with their asset allocation. And we are now launching an ex-UK version, which will be our European focus fund, with the UK portion stripped out and replaced with holdings from our Eurozone fund, which is very exciting, because both the European focus and the Eurozone fund are managed by Matthias Born, who will manage our ex-UK fund, and they are top centile against the peer group for performance since inception. So it's very exciting. That fund is going to launch on 1st of June, and that's why right now it's very, very busy from our end, as that's something that's been very popular with the market.
So we've got these 2 webinars that are going to be produced by PCD later in the summer, featuring some of your staff fund managers. Perhaps you could set out some of the things we're going to cover across those sessions.
Yeah, absolutely. Well, we could have done so much. I mean, the breadth of what we could have spoken about was so wide. We ended up settling on 2 webinars and I think 3 roundtables. And I think that's a good structure for what we want to bring to the PCD audience. So for the first webinar, I believe, I think it's the first one, we've settled on European small cap opportunities. There are a few reasons for that. One is to give the PCD audience access to Peter Kraus, who is a star fund manager in the European small cap space. I think on Citywire, he was ranked the second, at the moment, he's the second ranked European small cap manager by Citywire. So definitely someone you want to pick the brains of. But secondly, it's an area that is under research, especially from the UK. It's an enormous universe of potential stocks available, which isn't very well covered. And you would say that it's an opportunity to bring to the UK expertise that Berenberg have from being a German house of that market intimately. And it's an area where there are potential for very exciting growth opportunities that would complement an entire portfolio that's constructed within the UK with a UK bias and very familiar holdings in the large cap space. The small cap European space is something that we've seen is a very good complement to those portfolios. And the other overarching trend makes it interesting is that there's a bit of a phenomenon in Europe where innovation and the most exciting companies are probably found within the small cap space. Whereas if you compare that to America, almost the most exciting advancements and innovation that you find is found by the mega caps who invest into R&D and then produce the next technology. Whereas in Europe, it's more about brand new companies, almost creating new niche markets with products that could very well grow to affect all of us day to day across the different spaces that we operate. So I think that's something that would be interesting to the PCD audience and is a little bit different to what else we might do. And the second webinar that we were going to touch on, I think, is about the mega trends or structural themes that Berenberg, the Berenberg investment philosophy likes to invest within. So we look for, within the fund range, organically growing companies, growing at double-digit rates, that have a niche position in their market, a competitive advantage, but also find themselves within a structural trend for the long term. And the reason for that is that then when they reinvest their cash flows, their growing cash flows, they get the best compounding effects. And I think that's interesting because these mega trends are something that have come into focus very much within the pandemic. If you look at the fact that we are doing a Zoom call right now, and cloud computing, healthcare, diagnostics, these are all things that were in place as megatrends anyway, and have almost got a kick from the pandemic. And these are things that will affect all of us, whether we're aware of it or not, for the foreseeable future. So it's an interesting content piece. And I think looking at someone like Matthias Born or Peter Kraus, who have intimate knowledge and have studied them and studied all the data, it'd be a very interesting conversation, which can then be followed up through an informal roundtable one-on-one on those trends and where they see them going and challenge, etc. And I think that's a very compelling piece of learning for anyone who's interested in that phenomenon. Really, it's always constantly moving. And where we are right now, I think, is probably a very interesting time to look at it, given what's happened with the pandemic.
Well, thank you, Sidd, for talking to us today. We look forward to sharing this with our members and bringing forward more information about the content we're going to produce together over the coming months. So thanks for talking today.
Thank you, David. Thanks for having me.